A little riddle. What is the financial metric that is controlled by operational managers but is crucial for financial managers? That appears on the balance sheet but is only revealed after a very little calculation? That requires invested capital when positive but generates it when negative? That has a strange name for financiers but is a concern for everyone in their personal lives? Answer: the expected cash flow, that is the working capital requirement.
Hello to all entrepreneurs, students, and finance enthusiasts. Today, I propose we analyze together this enigmatic working capital requirement. What does it represent? How is it calculated? What is its impact on a company's financial management? Let's consider this beautiful mountain landscape. The operating cash flow is like a lake fed by a waterfall, the potential cash flow generated by the company's performance, but which partially drains to the river of working capital requirement. Thus, variations in working capital requirement directly impact the level of operating cash flow. They are therefore a key factor in cash management. So, let's see why such variations exist.
Let's take a very simple example. A company buys goods for 40 and immediately sells it for 100. It therefore makes a profit of 60, which will be recorded in its income statement. However, the purchase terms with its supplier are as follows: 50% payment upon delivery and 50% 1 month later. On the other hand, the company requires its customer to pay 40% upon delivery and the balance 1 month later. The company's cash flows will be: cash available immediately, 40% of 100 to 50% of 40. So, 40 minus 20 is equal to 20. Cash expected in 1 month, 60% of 100 to 50% of 40. So, 60 minus 20 is equal to 40. Thus, the profit of 60 is split into 20 now and 40 later. The potential cash flow of 60 is transformed into an operating cash flow of 20 now with an expected cash of 40 later. Of course, this anticipated cash flow will be received. But in the meantime, other goods will be bought and sold, generating cash inflows and outflows, as well as pending cash flow. This pending cash flow is referred to as working capital requirement. It represents the capital the company must invest to operate, taking into account payment and collection conditions. In fact, working capital requirements are defined as the amount of inventory, accounts receivable, and prepaid expenses minus the amount of accounts and other payable. Alternatively, they can be defined as the amount of current assets, excluding cash, minus the amount of short-term liabilities, excluding short-term bank credit. Let's take a simplistic image. The working capital requirement is like an ice cube melting in a glass that would contain the cash position and from which a pipette would absorb the payment to suppliers. But how do we integrate this working capital requirement into a balance sheet to extract all the information necessary for effective financial management of the company? To do this, let's transform the balance sheet in its accounting form of assets, liabilities, and equity to obtain a financial balance sheet that juxtaposes invested capital and employed capital like the two sides of a coin. To illustrate this, let's look at a balance sheet diagram with the main items. Invested capital is on the right side of the balance sheet and easy to identify. Capital and its retained earnings are part of the capital invested by shareholders. Bank loans are capital invested by banks for a specific period. For the capital employed on the left side of the balance sheet, there are, of course, fixed assets, but also cash held in the bank, even if its return is not a major factor for the company. That leaves us with only 3 important items not yet allocated: receivable, inventories, and payable. And that's precisely the 3 components of working capital requirement. We can even move the payable item, which is currently on the right side of the debt section, to the left side of the balance sheet, using the minus sign. Thus, the working capital requirement is recorded on the left under capital employed. This is normal since this expected cash must be financed by invested capital, that is to say, by financial debt and capital invested by shareholders. We then have a balance sheet transformed into a financial system. The financial system, formed by the juxtaposition of invested and employed capital, thus appears with 5 elements. Financial debt, both short-term and long-term, and equity are considered invested capital. Fixed assets and working capital requirements are capital employed due to the company's operations. They are classified as busy capital employed. Cash available in the bank is called idle capital employed because it does not constitute capital producing a return comparable to the company's operating income. The financial system, formed by the juxtaposition of invested and employed capital, thus appears with 5 elements. Financial debt, both short-term and long-term, and equity are considered invested capital. Fixed assets and working capital requirements are capital employed due to the company's operations. They are classified as busy capital employed. Cash available in the bank is called idle capital employed because it does not constitute capital producing a return comparable to the company's operating income. Each element has its own requirements. Equity guarantees the company's value. Financial debt must be cheap. Fixed assets must be fruitful. Working capital requirement must be as functional as possible. Finally, the final cash flow should be investable, therefore the cash held in the bank must be minimal. If you're interested in the financial system, please watch my YouTube video on the subject, File the Balance Sheet. Let's return to the working capital requirement and examine the main characteristics.
If this video is helping you out so far, consider hitting that subscribe button and toggling the bell to all. It's the best way to stay updated with my guides and it really helps the channel grow. Thank you very much.
What are some important things to know regarding the working capital requirement? First, it's not fixed but changes daily based on customer invoices sent and supplier invoices received. Second, there's a constant exchange with the cash held in bank position during cash inflows and outflows. Finally, it fluctuates according to the company's activity. Therefore, it's subject to constant monitoring by the company's treasurer. Another way to visualize and even anticipate changes in working capital requirement is to calculate them not in monetary terms but in days. Simply determine the average number of days goods remain in inventories, add the average number of days it takes to receive payment for a customer invoice, and subtract the average number of days it takes for supplier invoices to be paid. This highlights the importance of inventory turnover and payment terms. There are companies with very rapid inventory turnover, or even no inventory at all, where customers pay cash while suppliers are paid 1 or 2 months later. The amount of accounts payable then exceeds the value of inventory and accounts receivable, resulting in negative working capital requirement. This is no longer listed as capital employed with a minus sign but becomes invested capital, in absolute terms, at the cost of suppliers. We call this opportunity capital for the company. This invested capital is indeed an opportunity, but it must be used wisely. In fact, this capital is short-term in origin and should therefore not be tied up in fixed assets. If it is, it should be in such a proportion that a sudden drop in the company's activity would not jeopardize its survival. In conclusion, the management of the working capital requirement is paramount. This is due to its timing in managing immediate cash flow, but also because it forms a bridge between operations and finance. Operational managers tend to maintain larger inventories to satisfy customers and offer attractive payment terms to close deals. It is the role of financial managers to demonstrate all the consequences of this at the company level.
Lead and grow your business with strategic financial mastery. In today's competitive world, leadership requires more than vision, it demands financial fluency. Our programs are designed for those ready to transform their understanding of finance into a strategic advantage. Whether you're scaling a startup or leading a seasoned company, this journey with mycampusfinance will sharpen your ability to make bold, informed decisions and unlock sustainable success. Thanks for watching, and I'll see you over at the campus.
Here are some resources to deepen your knowledge of accounting and finance. They are available at Amazon. Thank you for your trust.